Next in our series of podcasts on craft beer finance is we want to discuss a ratio which I think for small businesses and especially growing small businesses, the cash conversion cycle is one of the most important to monitor for that growing business. If we remember back to our previous podcast, our craft beer distributor had a liquidity ratio of 84% for both 2012 and 2013, and that ratio declined to 80.5%. Again, we want to see that ratio staying the same or increasing over time. And that brought us to this concept of working capital required, or what we call WCR, and how we have to balance that. In other words, are we leaving inventory on our shelves too much? Are we ordering too much? Are we collecting fast enough on our receivables? Are we paying our vendors and our employees too slowly, too quickly? And we got to balance all 3 or 4 of those components in helping us monitor our cash flow, and yet still taken in relation to our service levels. When we talk about the cash conversion cycle, what we're going to come up with is a ratio. And it's going to be a ratio that the end result will be in days, and it'll basically give us an idea of how long it's taking a dollar to circulate from our business. In other words, when we order and purchase inventory, build it, sits on the shelf, we've got dollars tied up in that. Then as we sell that inventory, we don't necessarily get paid right away. We have to wait till we collect our receivables. So in other words, our collection period. And that can be offset by, the way we can offset that is by maybe not paying our vendors or accounts payable or accrued expenses as quickly as possible. We want to look at the cash conversion cycle in cash flow management as the first place to monitor our cash flow, and also to try to figure out ways to improve that. If you recall the distributor balance sheet, pretty straightforward. We'll use that in our cash conversion cycle. We'll be basically pulling out the numbers, receivables, inventories, as far as the key current assets. We'll also be using the accounts payable and accrued expenses, those things we call spontaneous non-interest bearing current liabilities. In other words, those liabilities that we have to pay off really quick that are part of the operating cycle of the firm. So when we look at our cash conversion cycle, we literally calculate 3 different components of it. First is the inventory days on hand, where we take the inventory at the end of the year and divide it by our daily cost of goods sold. In this case, we're taking the annual cost of goods sold from the income statement and dividing it by 360 days. We add that to our average collection period. So we have inventory days on hand of about 58 days in 2012. The average collection period is how long customers are taking to pay. We calculate that with our accounts receivable divided by our daily sales. Again, taking annual sales, dividing by 360, and calculating what our average daily sales are. There you can see in 2012 it's at 41.2 days. And we add those two together, the days on hand plus the collection period, which would roughly be about 99 days it's taking for $1 to be collected from our customers after the inventory has been built and sold, added together. We offset that by what we call our payment deferral period. One way we can offset the impact of cash being tied up in inventory and in receivables is by how quickly or slowly we pay our vendors and our accrued expenses. So we create this account called spontaneous current liabilities, which again is accrued expenses plus accounts payable. We divide it by average daily cash expenses. Now, average daily cash expenses, this is somewhat of a crude number, but literally what we're taking is we're taking our income statement and adding back any non-cash expenses like depreciation to come up with a cash expense for the year, and then dividing by 360. Divide those spontaneous current liabilities by the daily cash expenses, and you can see roughly we're paying in about 36 days. Now we add the first 2, subtract from that the payment deferral period. You can see in 2012 our cash conversion cycle is roughly about 62 days. Or roughly it's taken us about if we take 62 days divided by 360, about 1/6 of a year for $1 to circulate before it comes back into our business. We can watch that number and look at it over time and see that it stayed about the same, a little improvement in 2013, but went significantly up to almost 69 days in 2014. That we can relate back to our net liquidity position, the liquidity ratio, as kind of descriptive way of saying, oh, okay, that's why working capital requirement went up. It looks like it's because our inventory's gone up significantly. Now again, if we want to know if these numbers, how they relate to industry averages, we can use those numbers put together by the NYU database, just to give you a sense of, again, like alcoholic beverage industries, what their accounts receivable are as related to sales and so on, just to give us a ballpark. So now we're starting to put together a series of measurements to help us monitor or at least our monthly and maybe even our weekly and daily cash flow, to try to give us a sense of a couple of key indicators to tell us if things are tracking well or if they need improvement, and plus how we compare to our competition.